Welcome to AM Best Audio.
Portfolio managers today are facing a complex mix of economic pressures and market volatility, making allocation decisions more difficult than ever. I'm John Weber for Best Review Magazine, and I'm speaking today to Amar Reganti of Wellington Management, who draws on both private sector expertise and his experience as former Deputy Director of the U.S. Treasury's Office of Debt Management as we explore the macro drivers he's watching, the priorities for portfolio managers in this environment, and how Wellington is tailoring strategies to help insurers navigate today's fixed income risks. Amar, so glad you could join us today.
Thank you for having me on.
So, Amar, what primary macro drivers are you watching right now?
I think we're focused on three key macro drivers. One is to better understand the evolving trade landscape and trade architecture that's on the heels of the April 2nd Liberation Day tariffs that were imposed. Now, current tariffs are far from the high levels that we saw at that point, but effectively still stand at a level that we haven't seen in nearly 90 years. Understanding the overall impact of tariffs, both on growth and inflation in the United States, is going to be critical to seeing where the bond market and interest rate markets are likely to head over the intermediate period of time. Within that, the second thing that we're really spending a lot of time focusing on is inflation, which has been pernicious and more sticky than markets had anticipated for 2025. We expect that inflation is going to gradually continue to rise above 3%. And we think that's going to provide the Federal Reserve with a sort of conundrum. That conundrum is the Federal Reserve's dual mandate is one of both full employment as well as price stability. And unfortunately, with the almost nonlinear impact of tariff policy across the whole basket of goods within the United States' consumer basket, as well as corporate inputs for manufacturing in the U.S., we think that should edge inflation above that 3% number that I mentioned earlier, and well above the Federal Reserve's 2% target for the year. Overall, what we're seeing in time here is that there's a growth inflation trade-off that's becoming a lot less flexible for the U.S. As it sort of enters this new world of trade dynamics.
What should insurers prioritize given today's economic environment?
Yeah, despite what I would almost consider the dire sort of statement I made in answer to your last question, in our mid-year outlook, what we've consistently said is, you need to quote unquote keep calm and carry on. And there's a sort of pun there, which is that fixed income markets offer robust carry at this point in time, whether it's in higher quality fixed income or higher yielding fixed income. Insurance companies are now able to achieve book yields that just several years ago seemed substantially out of reach. So from our perspective, there's a wide variety of opportunities in fixed income markets that insurers can take advantage of in this high yielding environment that allow them some cushion against the overall macro volatility that's serving as a backdrop to this. And that can be in areas such as agency MBS, CMBS, long-dated tax-exempt munis, parts of the CLO market. But additionally, with the growth of private credit, I think insurers and private assets generally, it makes sense for insurers to look across that entire spectrum of privates to see if they're as diversified as they can be and sourcing credit risks from as wide of a variety of sources as they possibly can. And that's because they'll be less likely to be subject to any type of idiosyncratic risk that can particularly affect one sector or another right now. So from that perspective, I just think, it's almost a two-handed thing, which is one is that enjoy the benefits of higher yields right now, but two, make sure you are getting diversification across your entire spectrum of investments.
Now, you previously served as the Deputy Director of the Office of Debt Management. So, Amar, how does that public sector experience inform your current perspective in private sector asset allocation and client strategy?
It's a great question. I had been a portfolio manager before I left for the Treasury Department just after the financial crisis. I had meant to stay for a year. I ended up staying for almost four. And the public sector lens, looking at financial markets, I think is really unique. You have to almost focus on both the high and low aspects of financial markets. The first is, in terms of the low, you need to have a very granular understanding of how capital markets work in almost the plumbing type of capacity, whether it's repo financing and clearing and financial stability concerns and institutional capital. But at the same time, you have to have a much longer perspective in terms of where is policy driving markets and the private sector over the course of 10, 20, or 30 years. So to me, that ability to kind of look from the top down and the bottom up has probably shaped almost every day that I've worked since I left the Treasury Department. And to me, I feel like it's given me a perspective that I feel like it's unique.
What are the biggest fixed income risks facing insurers today?
So there's a number of risks, and I don't want to highlight the fact that markets have generally been actually very well behaved in both interest rates and credit spreads over the last several months. But I think the first important part is that the U.S. economy right now is actually in generally very good shape. And what I mean by that is that the majority of the private sector is in far more robust shape than we were in 2008, 2009, the years leading up to that, or in the late 90s leading up to the events of the early 2000s. Corporate balance sheets have generally termed out their debt, and most of their debt is broadly affordable. The consumer has spent the last 15 years since the GFC deleveraging. State and local governments, again, are at very healthy starting points, and banks, at least the largest ones, appear broadly well capitalized. So from our perspective, a lot of these tight spreads are justified. However, the risk to all fixed income is, what if you're wrong? And what I mean by that is that what happens if there is credit risk percolating in parts of the market that are more opaque, but yet could have spillover effects? One could be, is there hidden risks in parts of the private sector, the private credit markets, direct lending businesses? I think that's much, much harder to monitor from a top-down perspective. And then two, if there is some type of downward risk-off in equity markets, that could easily spread from a sentiment perspective into spread markets, and then maybe push to some type of credit cycle with elevated defaults. None of these things are guaranteed, and we don't consider them as part of our base cases, but these are real risks. I think the second risk is one I call stagflation light to stagflation heavy. We are right now looking at a world of what I'd call stagflation light, which is elevated inflation, modest growth, still positive, but modest growth. But that inflation rate likely could be higher than the growth rate we would see. That's generally, what we call stagflation light. Events can occur where you have stagflation heavy, and that is more reminiscent of the environment of the 1970s. Now, a lot of times those events are exogenous. In the 1970s, that was because of repeated oil shocks on the back of easy monetary policy and fiscal spending. That, again, is not our base case, but that is a risk because exogenous events are things that we necessarily can't predict. And then finally, the third thing, and I think this is something all capital markets participants have to be highly focused on, is institutional degradation. We're speaking on a day where, a Federal Reserve governor is, at this point, being asked to resign or being fired, depending upon, which statement you're reading. We're not commenting on the merits of that, but and the courts will have to decide on whether or not this case, how this case moves forward. But what's really important is that this is the most, this time the executive branch is moving pretty expeditiously ahead to engage and move the Fed into a position more aligned with its thinking through the usage of these of openings on the FOMC. U.S. capital markets have sort of operated with the assumption that certain institutions, had effectively independence. It's hard to know how capital markets will react if that assumption proves not to be true over time. So that's a risk. It's hard to exactly map out what that risk is, but it's also, you have to be aware of it and think about how that fits in your intermediate time frame for investing.
So, Amar, how does Wellington help insurers navigate a volatile economic environment?
So I think, from Wellington's perspective, just our platform alone across the public and private asset classes and its breadth and its depth is there to make sure that we can calibrate the right investment strategy for any of our insurance clients. And whether it's needs driven by things like their liabilities, or whether or not it's to take their existing portfolio and help it achieve goals that they feel like they need to meet. And then additionally, it's not just our investment expertise and the breadth of our investment expertise across fixed income, equities, and privates. It's also the way that we can put these investments into vehicles and structures that make insurance investing easier. Whether it's separately managed accounts tailored to the needs of the to the end insurer, or whether it's in structures like rated note feeders, which have now become much more common across the insurance landscape. In all of these cases, Wellington Management is there to make sure that we can help our insurance clients to the best of our abilities and their needs.
Amar, thank you so much for taking the time to speak with us today.
Thank you for having me.
That was Amar Reganti of Wellington Management, and I'm John Weber for Best Review Magazine.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.